Today I would like to talk about Casio Computer. It's a small company, it's an interesting company, and they sell watches. The popular watch is G-Shock, but they also sell instrument and their very popular calculator. So they have interesting products, but we can see the stock price decreased over the 5 years, significant, over 40% down. And from this high in 2020, it looks even worse with 60% down. So it's an interesting company to look at. So we have to take a look at the financials to find out more. The first thing we can notice is a market cap of 262 billion yen. So how much money is this in dollar? So this equals around $1.76 billion. So it's a small company, but it's not too small actually. We can also see here they have a dividend yield of 3.91%. So that's not a bad dividend as well. And we can take a look one more. And I will show you the dividend history. So they have an interesting dividend history. We can see they didn't decrease the dividend for over 10 years. Let's take a look at the financial foundation. The first thing we are looking for is revenue growth, because we want to invest in a growing business and not a decreasing business. So we can see here in 2019 it was about 298 billion yen, and in 2023 is 263 billion yen. So we can see it has a decrease over the years, it's not increasing. And this is not a check here, so actually we don't like to see that. But that's also the reason why the stock decreased so much. So it has a reason why it's so cheap. Now we are looking for free cash flow growth over the last 5 years. So we can see here it was in 2019 13.61 billion yen. And now in 2023 it's even less with 6.7 billion yen. So it's a decrease as well, but we also had the increase over some years, as we can see here in 2020 and 2021. So, but now it's decreased, so it's not a check here. Now we are looking for the free cash flow yield over 4%. So what we're gonna do is we take the free cash flow of 6.7 billion yen and we're gonna divide it with the market cap of 262. So this will give us the free cash flow yield. Okay, it's about 0.0255. This means 2.55%, and it's under 4%, so it's not looking great actually. It's not a check here as well. So we have to consider at some years the free cash flow was way higher, so then we would be over the 4%, but in 2023 it's not like that. Now we're going to take a look at the balance sheet. So we want to see the debt to free cash flow ratio under 5. This means we can pay back the debt with our free cash flow in under 5 years. So it's a very important number for us. So we're gonna take a look at the debt now. We can see here it's a short-term debt 27.53, and then we also need to take the long-term debt. This is here 26.27. So then we're gonna divide it with the free cash flows that we have, 6.7, and then we will get the number that we're looking for. Okay, it's actually 8.02. So it's also not a check here. We can pay back the debt with our free cash flow in about 8 years. So we would like to see this under 5. But I also want to take a look at the cash on hand. So we can see how much cash on hand they have. And we can see here they have 130 billion yen cash on hand. So this is a very good amount. They can pay back the debt with this money. So the debt is about 55 billion yen, and they have over 130 billion yen in the bank. So they can pay back the debt already. So this is a very important number two. And they could buy back shares and pay the dividend. So they have they have cash in the bank, but I think it's very important for them to invest this in the business as well, to make the better products and to make the better business opportunities for them. So this money should not necessarily be spent on dividends or on stock buybacks. The last point would be shares outstanding decrease. So especially if a company is undervalued, we would like to see the company buy back their own shares. So we can see here Casio actually did buy back shares over the last years. They have less shares outstanding. So they did buy back, but it's not a significant amount. It's a little bit over 1%. And it's a check here. I would like to give my conclusion about Casio. So let's start with the good things. They have a good cash amount. They have more cash than debt. So they could pay back the debt with the cash easily. This is a good thing. They can use this cash as well to invest in new business ideas. So the next thing would be they buy back shares. So when they buy back shares, this can also increase the stock price. So actually over the years, it didn't increase much. So the stock price decreased anyway, even though they bought back shares. So it didn't really help much. And the other things I don't like is the declining revenue and declining free cash flow. So it looks like the business is dying because the revenue declines, the free cash flow declines. So it looks like this company is in a very difficult situation, and it needs to really find new business ideas or make better products to turn this around. And in general, I think it's a tough business to selling the watches, especially the cheaper watches, to selling the calculators. I think they're quite strong in selling calculators. They have a very famous brand and they are popular about this, but the question is this a growing business? And I don't really think so. So I believe this company is not really a good buy, even though it looks cheap in some way. So I hope you liked the video, and please don't forget to subscribe and like the video.